Neal is a apartment syndicator who has a very strong focus on markets. So not just on the actual property and the numbers for the property, but also for the market that the property is in. Because that's where a lot of the money in multifamily, just as it is in other real estate, is made, is by buying in the right market. Neal has been at this for quite a while. Neal has been involved in over 3,000 units so far. He currently still is in about 1,000, Neal? A little over 1,000. You'll ask why. Because now is a good time to sell, obviously. Anyway, I'll let Neal finish off his intro himself. But yeah, everybody, please give Neal a hand. Welcome.
Is this one on? I don't think it is. Okay, let's turn that on. All right, perfect. Boy, I gotta say, this is easily the best view I've ever had for any of my presentations ever. And it's also the best looking office. I think what you guys have done with this office is absolutely phenomenal. I spent 20 minutes just walking around, taking in the lighting, the carpets, the separators. To me, this place is exquisite. This is Taj Mahal for people like me that build campuses and build buildings. So I'm so excited to be here. So I wanted to start off by saying that I'm very far from real estate royalty. I've not been selling homes since I was in my diapers. I'm a technologist, and I've had a successful tech career and a successful tech exit and education company. Some of you have actually been in that company because if you come to the Fremont campus, that is that business that I exited. And I fell into real estate accidentally because that company was cash flowing really well. I was paying 50+% in taxes each year. And I walked into my boss's office and I said, he was my partner and my boss. And I said, Paul, I don't work for you anymore. I work for the IRS. And he said, yeah, I knew you were going to walk into my office one day and say that. And so here's what I'm going to do. Called in his assistant. He said, buy us 2 tickets to Los Angeles. And he takes me to Los Angeles and we go to this really ugly apartment complex, right? So you walk in and he owns this apartment complex. It was a small one. It was 20 units. And as I'm walking through, it's like, oh my God, this place is hideous. So I tell him, Paul, this place is ugly. And he's like, I know. And I say, no, Paul, I mean, it's ugly. And he says, I know. And I realize this is a teaching moment. And I'm supposed to learn something here. So I said, so ugly is good? And he says, yes, ugly is fantastic. Ugly is awesome. Ugly is how you make money. And obviously, I went back 6 months later, and by that time, it looked much better. So he'd done the rehab. It was a standard $6,500 a unit type of rehab. But I was amazed not by the way it looked, because it still looked okay. I was amazed by the difference in the net operating income. He had taken it from basically no NOI to a spectacular level by doing that upgrade. And it just sort of opened my eyes to what was possible in real estate and the magic of cap rates. It just captivated me. And since then, I've been in love with real estate. And oddly enough, I started in real estate in a way that most people don't start. You know, people do single family, and then they do duplex and quadplex, and then they go for the big ones. And I actually started with a 27,000 square foot commercial shell that I bought in 2003. Our school was expanding. It was a technology school. And I needed to build classrooms. And there were no places zoned for that. So I had to learn how to rezone, and I had to learn how to do classroom construction and do a lot of interesting things and deal with fire codes. And so it was a trial by fire. And then I went on to the next campus, and I knew I needed the campus, but I didn't have the money. So this was in 2006. And I came up with this concept at that point in time of condominiumizing an office building, selling off pieces to individual investors, and then renting the campus back from them as my company grew. That was a very complex process. There was a lot of pieces to it. And that's when I realized that involving individual investors and forming a consortium could create an enormous amount of money. So that was my first connection to syndication. And then I really started on single family. So I bought 10 properties in California, ran out of loans, refinanced, got my wife's name off, went to Chicago, bought duplexes and triplexes and quadplexes, ran out of loans, and then started looking at multifamily and syndication, started investing with lots of different syndicators throughout the US that were doing fantastic things, and then started to push them to see if I could sit in on their calls. All this while I'm running my company. This is many, many, many years ago, and I'm still a technologist running my own company. But I started going in, and I noticed a few things. A lot of these real estate guys, fat cats, they had a lot of money. They were great at what they did. Some were good at buying, some were good at selling, some were good at marketing, but not a lot of them were good at analytics. A lot of them loved to say that they were data driven, but they weren't. In fact, I can tell you the vast majority of the people in this room are not data driven. If I say, are you data driven? Everyone is going to stick up their hands. But if I ask you 5 questions, I bring you up here, 90 to 95% of you will not be data driven. And that's because we're only data driven to a certain point where it agrees with our beliefs. Beyond that, we don't look. So I realized you could make a shitload of money in real estate for yourself and eventually for your investors if you were truly data driven. So I started down that path, and I used my webinars to hold myself responsible. So today you're going to see predictions from me, and when I come back next year, you can tell me how well I did. So let's get started. This is my favorite presentation, Real Estate Trends. It's an investment forecast. Now, because of this audience being primarily an audience that's interested in either single family or small multifamily, 2 units, 10 units, 20 units, this is mostly a single family forecast. At some points, I'm going to interrupt the flow of the presentation and say this also applies to multifamily, or this is a great multifamily city as well. But for the vast majority, this is meant to be a single family sort of presentation. So let's look at the agenda, right? So the best place to start always is the economy, because more than before, real estate, especially since 2008, is very connected to the world economy because we're dependent on ultra low interest rates. We're dependent upon money coming in from outside the US. Over $10 billion a month comes in from outside the US to support the US real estate market. So the economy has an impact on both the prices and the cap rates. And then we're going to talk about the impact of interest rates on housing sales, right? Is there anyone in this room that at this point still believes that the super low interest rate era is not over? Anyone? It's done. All right, we're going to have a conversation that's going to be very interesting at the end of this presentation. I believe it's finally done, right? So for 2 or 3 years I've been saying not yet, not yet. But I'm going to show you a couple of indicators that at this point seem to prove that that era is over. We will see significant interest rate hikes this year. So we're going to talk about those. And then I'm going to move on to 3 other factors. They're all connected to each other. Jobs, inflation, unemployment. They have a significant impact on what is happening in real estate, whether it's in the Bay Area or anywhere else in the US. And then we're going to talk about the big trend for the year. This is the one that has the most impact. Now, this is a single family presentation. This is actually a more fun topic on the multifamily side. There's a very significant impact there as well. We're going to stick mostly with single family and talk about the impact of tax reform, especially in the Bay Area. And then I'm going to do a quick check. A lot of people that are Bay Area based have this belief that Bay Area cities always have the highest appreciation. And because they are the best quality markets in the US, they also bounce back first from a recession, right? So that's a very consistent belief. A lot of people have it. So we're going to look at what cities have rebounded to pre-recession peaks, and we're going to rank the top cities in the US, and we'll see where the 3 big Bay Area metros come in. It's going to be very interesting. And then I'm going to segue to something that isn't a trend. I just threw this in there because it's cool. It's interesting. Lots of people are talking about it. I think it's the beginning of a trend. I think that Amazon figured out that if you crowdsource headquarters that should have cost $10 billion, you can end up paying $4 billion and get $6 billion for free from cities that are falling over themselves to give you tax breaks. And I think that now everybody else has figured this out, that, oh, wow, this is cool. Next time I build a campus, I'm going to start one of these competitions as well. So I think it's the beginning of a trend, but mostly I'm doing it simply because it's interesting. So we're going to pick some cities. We're going to talk about our top 3 picks for 2018. And then we're going to go into the section that is usually the most popular, a shootout. So different this year. Last year, people gave me feedback and said, the shootout was great, but I had a problem. I couldn't tell if the cities that you said were the best for fix and flip. Were they best for price appreciation? Were they best for rent appreciation? So this year, I sorted them. So I'm talking about best cities in the U.S. for fix and flip, best for price appreciation, best for rental appreciation. So you'll see 3 sets of cities. And what I'm interested in is commonalities. Isn't the very best kind of city the one that shows up in all 3 of those? Well, as you'll find, in the U.S., there's only a couple of cities that show up in all 3s. But it's very interesting and surprising cities, and they're closer than you think. So the last part, by the way, let's go back, is my picks. So usually at the end of the year, or the beginning of the year, I like to stick my neck out and pick a city. So I'm going to pick one California city. It's actually a fairly small one. And then I'm going to pick a city in the U.S. that is not going to show up in my graphs. One of the benefits that I have of buying paid data is all of the stuff that you're going to see up here is not paid data, because I would get sued if I was in a room with 100 people and showing them paid data from CoStar, Axiometrics, or any of these providers. So the data you're going to see is from 8 different providers. They'll be listed with their logos up there. But if I look at the paid data, that gives me another 6 or 9 months of advantage, and based on that, I'm going to pick 2 cities. So those are going to be very interesting. Actually, a couple of people outside were talking about one of them, so we'll see how that city fares. All right, so let's get started. So very, very strict behavior rules for all of my presentation. No interruption. Don't put up your hands. No questions until the end. But most importantly, ignore all of those rules. I want this to be interactive. Stop me. You have a thought, stick up your hand, and let's talk about it, because this is meant to be a conversation, right? It's okay to have segues. It's okay to go off topic. I'll always bring it back onto topic. But yes, I want to hear from you. So don't wait until the end. Don't write down your questions. I'm going to skip past this disclaimer. This is an educated audience. So my company, I don't want to spend a lot of time doing that. Multifamily and student housing, over 1,000 units at this time. We're buying and selling all the time, so that count goes up and down. And the part that I'm going to talk about today is this bucket, right? In this presentation, identify, verify, figure out the best markets in the U.S. That's really the focus of this presentation. That's our portfolio. For those that are interested, we've had good returns, 35%, 55%, 28% annualized on projects. Some of them not doing well. This is actually a project that we're struggling with. All right, now let's get started. Outlook, world economy, U.S. economy. How are we doing? This is going to be one of my most bullish presentations. I'm mostly known as a bear. But I can't help but feel good about 2018, because it all starts with global growth. The U.S. tends to be a direct beneficiary of accelerating growth. Bloomberg says we're going to see 4%. 4% is a spectacular rate at this point for the world, and we're going to see it for the first time in 7 years. That's a terrific rate. And that's where it all starts, and as a result of that, you're going to see above-trend growth in the U.S. economy in 2018. So some folks, the IMF predicts 2.7%, Goldman Sachs is at 3%, but no one's predicting trend growth. Everyone predicts significantly higher than trend growth. The big factor is tax reform, but not because Trump gave you some money, because that's really peanuts, right? It's a very, very small amount of money. It's because of this, 35 to 21. There's $200 billion worth of money that corporations have stashed away in overseas accounts. And a significant portion of that money will now re-enter the U.S. Some of it will go into your pockets as dividends, because you're stockholders, right? You're an Apple shareholder. Some of that money will come back in. Apple has the largest stash. But some of it will get reinvested into the economy. So it'll be short-term. Companies will buy buildings. They will go out and hire more people. That gives the economy a boost. The only bad news here is that everyone that is talking about this says it's a short-term boost. It's a 2018 boost followed by a somewhat lower 2019 boost. 2020, we go back to trend. And then after that, we go below trend, because this is borrowed money. We didn't really have this money. We spent money that we didn't have. So obviously, somewhere down the line, we have to pay for that. But for those of you that are looking to invest today, 2018 is a very, very good environment. Absent black swan events like 9/11, this is going to be a terrific year, not just for real estate, but for the general economy, world and US. So whenever you have an improving economy, you should start seeing inflation, right? That's going to give you some indicator of whether the economy is really accelerating. Inflation occurs very naturally during those times, and sure enough, we started seeing that, right? So CPI jumped in Jan, and then on Feb 14th, which was last week, the stock market had a conniption, right? It just hiccuped, right? And you know what was really odd about that? It hiccuped because there was a lot of good news, right? And people are like, why is the stock market crashing if all the news is good? You know, inflation is going up, goods were going up, the deficit was falling, the trade deficit was falling. Why is this good? It's because the market is finally coming to grips with the fact that we're finishing that super low interest rate era, and that the Fed will raise rates 4 times, and we know that in the long run that has a significant negative impact. So the market is adjusting to that fact, but overall it's not really bad news. If you own real estate, it's good for you, right? Higher inflation means higher rents, so you have the ability to raise rents. Obviously, if you haven't bought it yet, that simply means it's going to get more expensive before you buy it. So let's look at that impact. Let's look at that impact of higher rates on housing sales. I'm going to do a quick short video here, and we're going to talk about 3 or 4 numbers that are going to come up in that video and what those numbers really mean for the San Francisco Bay Area in particular, because most of you are from here. So for those of you that are watching on Twitch, they may not hear this. So a number of very interesting things there, right? So a few numbers that I wanted to point out. 6% of the people as an impact of higher interest rates, if we go to 5, right? Today we're at 4.64%, right? Which is a heck of a lot higher than it was 6 months ago. 6% of the people simply leave the market. They're just not able to buy, right? Now what's interesting is a quarter of the people accelerate their efforts to buy because now there's this paranoia that rates are going up, and we don't know how high they'll go, right? Actually, they won't go very far, but people don't know that. So you're going to see a boost. The Bay Area and most hot markets, we're definitely a hot market, are going to see a significant boost. I've done my research and it seems that the boost will last almost all of this year. So it'll last Q1, Q2, Q3. You're going to see an acceleration. You're going to see the number of days that homes are on the market to be lower, right? And significantly higher offers are possible. But that effect will fade within 3 quarters. And at that point in time, we have to deal with the fact that 6% of those buyers are simply leaving the market, and 1/5 of those buyers are choosing to leave. They're going to cheaper markets. Now, for the Bay Area, we have a number of cheaper markets. One is Portland. So for the Bay Area, a lot of people have been leaving and going to Portland. They used to go to Seattle, but Seattle is really expensive now. So people have been going there. In the last year, the city that has gained the largest amount of population leaving the Bay Area happens to be Reno, very close. It's Sacramento. So Reno is actually very, very close. Both of those cities have gained a tremendous amount. It's Sac that is gaining the largest population, exodus from the Bay Area. In fact, about 15 days ago, I saw a very troubling article. What I've always believed in is that yes, the Bay Area loses people all the time. We lose people to Texas and we lose people to Portland. But because there's more people coming in, it doesn't really matter, right? That's been my core belief because of immigration, especially from Canada, India, and China. But for the first time in January, the Bay Area lost population. We shrunk for the first time. And that is a very scary thing because our whole economy is based on significant and rapid population growth. So I want you to Google those articles. Those of you that want to read this, there was a San Jose Mercury article that said Bay Area inbound migration lower than outbound migration. So that was very, very scary. And I hope it's a blip, right? But I'm watching it very carefully to see if this is a trend that's developing. Obviously, the number one cause of this is housing affordability. Not jobs. We got plenty of them. Actually, the way that they do it is that they talk to U-Haul, they talk to all the moving companies, and then they look at all the airline tickets, and then basically they aggregate it all together and come up with the data. So that's a very, very kind of on-point way of looking at it because you get immediate data, right? So very interesting. So I think what that video is really saying is we actually get a short-term boost, but in the long term, we lose some people. They're just not able to be in our market. These are the people on the margin that just can't get loans. Does a rental market benefit? Yes, it does. But it's facing some of the same challenges. If they can't afford to buy a home, they also can't afford to pay much more for rent. So the rental market is also facing a plateau in markets such as the Bay Area and Los Angeles. More so in the Bay Area than LA. So if you look at the outlook, Doug Duncan, who I happen to know, Fannie Mae's chief economist, is saying the same thing. We don't expect rates to play much of a role in total home sales, especially with anticipated higher disposable household income growth. I'm not so sure about that. But the ongoing inventory shortages should continue to constrain sales despite ripe home buying conditions. I think inventory is a major problem. It is the big X factor in the Bay Area in 2018. We've got severe shortages. We've got the worst case of the NIMBYs, right? No one else has a NIMBY situation as bad as Bay Area. Because of that, I think we have another good year, but not necessarily with price appreciation and not necessarily with rent appreciation. And we'll talk more about that in a short while. Sorry, I should find that. What's NIMBY? Not in my backyard, right? The fact that as soon as a developer announces any kind of high density project, we find a variety of ways to stop it, whether it is, cockroaches that are native to that area that need to be preserved. I'm being facetious, but they find something, right? Some kind of plant or whatever it is. They find some reason not to let that high density building come up, and so it makes the problem a lot worse. Jobs, inflation, unemployment, these are all X factors. And I have to say, I've been doing this for a while, and I've never seen them look so clean. The U.S. unemployment rate, I was predicting right about here that we're going to stall, and we're going to go this way. Well, that didn't happen. There's a continuous downward decline. And, some people say, well, yeah, but let's look at the initial jobs numbers. That's more important. Well, it's almost a mirror. This is the U.S. initial jobless claims. Looks exactly like the unemployment rate. We're continuing to go down. If you know what this is, this was the hurricanes, right? So we had a little blip up because of the hurricanes, and then it's continuing downward. So a very nice downward trend. And the folks over at Kiplinger, who track this, say unemployment right now is at 4.1. They're predicting 3.8. I looked at 3 or 4 other numbers. They all look very, very good. A decline of 0.3 in such a tight economy will cause inflation. It will cause wage inflation. Why am I telling you this? This is a great year to ask your boss for a raise. It's awesome. If there was ever a good time, this is it. Ask for 2. So, one last bit, right? Inflation. This is a very important factor. There's a few people, right? This is for, hi, that's your name? Hi? All right, look at this. This is what has changed, right? This is why I believe now that rates are going up. So people were talking, starting here, rates are going to go up, rates are going to go up. And I'm like, no, inflation is at 0. Nobody gives a damn about raising rates when inflation is below trend, because what happens when you raise rates and slow down an economy when inflation is at 0? You can tip over into deflation. Deflation is a monster. It's highly dangerous compared to inflation. So the Fed was patient. And so slowly we started seeing a rise, and right about here in 2016, we started seeing a trend. And now we are at 2%, and that's exactly what the Fed likes. They like inflation at 2%. They don't like it higher. They don't like it lower. Goldilocks zone, 16 months. It's time for the Fed to do its thing. 4 interest rates, quarter point each, coming this year. But the good news is the consumers are feeling better about everything, right? We can weather this because consumer sentiment has not been this high for 15 years, right? So you look at the ranking where we were recession time, right around 50, 55. We're close to 100 at this point in time. Why does this matter? Because consumers, when they feel good, will buy. That's our default state. We feel good about ourselves. We feel good about our stock portfolios, about our retirements, about our jobs, about our income levels. We buy. This is a terrific number. And I don't think that we'll see this number for much longer. We'll see in 2018 and 19. In long term, this is way, way above trend. All right. So let's look at the housing market, right? Let's look at the trends. And when we talk about trends, really the big one that is affecting things, whether it's multifamily or single family, is going to be tax reform. Yes, question. Mm-hmm. Yes. I don't believe so. I think that a lot of this is bravado. Honestly, at this point, are you worried about North Korea? I think that's a good offline conversation. I would say at this point, no, I think those are contained risks. Obviously, North Korea has nukes, so you worry about those, right? You can't be frivolous with a country that has nukes. But I think a lot of this is bravado. I think a lot of this is political show. All right, so let's look at tax reform. So I want to show you a video from this guy that is the CEO of Redfin, okay? And he's clearly bearish on some of the coastal markets. So I got to warn you about this, and I don't necessarily agree with everything that he's going to say, but I have to tell you this, I've been following this guy since 2005. He knows what he's talking about. He's very numbers driven, he's very analytical. A bunch of people have tried to prove him wrong and have fallen on their face. He's one of those rare people that predicted the 2008 truly predicted the recession. So listen to what this guy's saying.
There is a real concern in high tax states like New Jersey, New York, Connecticut, California, etc., that this is going to cause a flight, that people aren't going to be interested in buying property in those states and that values will go down. How much of that is true in your view?
Well, we've already seen a mass migration to the center of the country. So even before there was tax reform, you had people leaving California, New York, New Jersey, all of these coastal cities that have been financial empires, technical empires, are really seeing an exodus where folks are coming to Houston and Dallas and Salt Lake City and Denver and Portland and Seattle. Tax reform is going to accelerate that. And the reason it's happening is because people want to avoid all the taxes they're now going to have to pay under the new plan.
So if I own a house in New Jersey, and I know it's not a very specific question, but if I own a home, should I be concerned, and I want to put it on the market in 2 years, should I be concerned that the value is going to go down?
I don't know that the value will go down that much because there's such an inventory shortage across the United States. We've become this landlord nation where most people are not selling as many houses as they used to. They're holding onto those properties and renting them out. So that's going to counteract what would normally be a larger price drop due to tax reform. So I don't expect a drop. I just don't think you'll see the price gains that we've seen over the past few years in the coastal cities where taxes have been high.
But how does that square with the idea that you're predicting a mass migration? A mass migration. Those were your words. I mean, I see this as, in terms of cash flow, a pinch in the wallet, but in terms of ownership of homes, a kick in the asset.
Well, I do think a lot of people are going to move to the center of the country. That's been happening already, and it's because the coastal cities are so densely populated, prices are so high, so people have been able to move because of telecommuting and technology, and they've been able to move because we can fly as easily as we used to drive. So you're just going to see more people going to Ohio and Michigan and other parts of the country that really were economically dead 5 or 10 years ago. And what's interesting about that, I think, is it used to be that in California, we owned the future. We felt like everything was happening here first. And now you see that swagger, that confidence in the center of the country. People in Detroit, people in Texas think they own the future. And I think tax reform has really given a boost to that argument.
So will this mass migration be led by individuals who decide that they want to move somewhere else? It would seem to me that to have that kind of mass migration, you have to have large employers, big businesses, J.P. Morgan Chase, people on that scale.
Amazon.
Moving.
I'm here in Seattle. Amazon is leaving Seattle.
All right. And then Facebook and Google leave Silicon Valley, right? I mean, or repatriate large chunks of their workforce. Apple.
Silicon Valley is going to leave Silicon Valley. That's already happened. Google employs more engineers outside of Silicon Valley than it does in Silicon Valley. And if Google can't afford Silicon Valley, then no one can. That is the most insanely profitable business in the history of technology businesses. So I think that is a harbinger of things to come. The technology companies, the Wall Street companies, they are chasing the talent. The talent is chasing affordable housing. We are going to see both businesses and people move to places that are more affordable. And it's going to be good for the country. It's going to be so good for the country. You shouldn't have that many people making so much money in just a few cities. It should spread to the rest of the country. It'll depolarize us politically, and it'll balance things out financially. It's going to be great.
Yeah, I did some analysis once, Glenn.
Years
ago.
I'll cut him off there. So, again, a bearish view of expensive markets, and I don't know if I necessarily agree, but I have to tell you, I grabbed this video about a month ago from a website, and then when I read that article in the San Jose Mercury News, it sent chills up my spine. The Bay Area is never supposed to see a reduction in population. That is scary. That's what happens in Ohio, right? It's something that we have to be a little cognizant of what he's saying if we actually start losing population. So I think his other point, though, which is good, is he doesn't see a price reduction coming, and I completely agree, right? We've got massive supply issues, and so price reductions are highly, highly unlikely, but the pace of price increases is likely to slow. And when I show you my charts, right, cities that are appreciating, you're going to see some of that impact amongst the most expensive cities in the U.S. So here's one that I do simply because every once in a while it's good to do some myth busting, right? One of the most commonly held beliefs amongst people that live in the Bay Area is our market is always the best, it always appreciates the most, no other market can ever match it, and that's why we don't need cash flow, right? So I hear this all the time, which means that in the top 5 cities that have recovered since 2006, right? This graph is going to show you numbers like 80%. So if it says 80% and the city is Dallas, what that means is 80% of the homes in Dallas today cost more than they did at the peak in 2006, right? And I don't know how much more they cost, but they cost more, right? And so you'd expect that the Bay Area's 3 markets, San Jose, Oakland, and San Francisco, would be in the top 5. Well, here you go. Denver, Dallas, Nashville, Portland, and Raleigh have recovered the most. So pretty much every single home in Denver today costs more than it did in 2006, right? No Bay Area cities in the top 5. There is a Bay Area city in the top 10, but it's next to Louisville, Kentucky. It's next to Indianapolis, right? So again, you think about your worldview of how the Bay Area is so outstanding in its appreciation that it doesn't need cash flow. Does this graph really agree with you? There's no San Francisco in the top 10. It comes in after Columbus, Ohio, in terms of appreciation bounce back. So keep in mind that we live in amazing cities, right? The Bay Area cities are considered extremely high quality. Whether it's JLL folks, whether it's Marcus and Millichap, consistently we rate this, if not the #1 market in the U.S., #2 in terms of stability. It's a core market. But that doesn't necessarily mean it's the best market for you. It might be the best market for somebody that's buying $1 billion building in downtown San Francisco. It makes sense for them, right? But you've still got to think about whether it makes sense for you from an appreciation and cash flow perspective if there's so many cities that leave the Bay Area behind. Also, the reason I put this chart up is because it shows opportunity. So I'm going to show you 8 different providers and their rankings of the top cities. 8 different providers. You're going to see that consistently a whole bunch of those cities are lighter blue, not darker blue. Because these cities have really peaked for the most part. San Jose is up here, San Francisco is up here. But a lot of the opportunity at this point, which comes with risk, by the way, so keep that in mind, is going to be when you start seeing lighter blue, especially when you start seeing these lower numbers. So you have a city like Las Vegas, which was the hardest hit in the recession, right? They had the highest amount of overbuilding. They built a ridiculous number of houses they didn't know what to do with. So they didn't build anything at all until 2016. So from 2008 to 2016, no construction whatsoever.
And so they ended up in a situation where home prices are still cheap. Only 0.5% of the homes are more expensive than they were in 2006. And we've had inflation. We've had 11 years of inflation since then. So now this is an underpriced market, which is why you're going to see it in my charts, right? Is it the best market in the U.S.? No, there's downsides to Vegas. It's a transitional market. But there's a lot of opportunity. A market that's much better that you're going to see a lot of is Orlando. So it doesn't have as many of the transitional issues as Vegas does. So keep that in mind that, yes, we've recovered from the recession, but we're not necessarily the fastest recovery. All right, so here's our little segue, right? So amazing Amazon, the HQ2 prediction. So 7 different providers ranked the cities. Moody's, Sperling's, New York Times, the Wall Street Journal, CNBC. So we basically said, okay, why don't we just group it all together and count, how many cities were ranked by each of them to come up with top 3 picks. So what's being invested though? $5 billion. That's a huge amount of money to invest in one city, by the way. That's spectacular, right? When Amazon happened, Seattle changed, right? It was an enormous impact on the city. How many jobs? 50,000 jobs. A lot of people think Amazon has low-end jobs. A lot of people think it's warehouses, people packing boxes. Go to YouTube and look at a new Amazon warehouses. 2 million square feet, 20 employees, right? A lot of Amazon's jobs are white-collar jobs. Programmers, logistics people, manufacturing people, those kinds of people. These are actually very good, very well-paying jobs. So again, these 50,000 jobs can change a city. So it's a huge, huge thing for cities. I think it's a game changer for whatever city they go to. So based on that, we looked at Amazon statistics, what they wanted, the things that they made clear. At number 3, we see Austin. So comes in because it has a terrific tech talent pool. It's a low cost of living. Now, you can't sell that to a Texan. They think, that Austin's really expensive. But for the rest of us, if you look at West Coast cities, it's a very inexpensive city. And of course, you can't beat Texas for business friendliness. It comes in at number 3. Its Achilles heel, it doesn't have an airport large enough, right? It's got a small airport. It doesn't have the ability to grow that airport, which is why it's losing to something like Boston, a deeper talent pool, an educated workforce. And it has an advantage that Austin doesn't have. They want to be on the other side of the country. Well, you can't get much further than Seattle to Boston, but Boston has a problem, and that is prices, right? Home prices. Amazon has made it very, very clear that they want to go into a city where home prices are lower than Seattle. Seattle's very expensive at this point, and that is why we think that the winner is Atlanta. Tech talent pool, a huge talent pool, lots of universities, a massive supply chain, right? This is the supply chain hub of the country. Massive airport with the ability to expand. And the airport, by the way, is in construction. They're adding to the airport. And this is important. Low cost of living, right? Homes are cheap in Atlanta. And it is also on the other side of the country from Seattle. So I would say there's a better than 50% chance that Atlanta wins. For those of you that are interested in investing in Atlanta, if you ask me, where do you go? Well, if this is a quadrant, the portion of Atlanta that's expensive is northeast. Go to the opposite quadrant. That's also the quadrant that the airport is in. So buying land in that area is a good idea for those that are high risk, high return sort of investors. But buying anything really in that area will be huge. Even if Amazon doesn't go into that quadrant, their suppliers will. Remember, only 10,000 of the jobs are Amazon. The remaining 40,000 are their suppliers. The suppliers want to stay close to the airport. So, before we go to the shootout, right, and start looking at the cities, just a little bit about our projects. Here's an investment opportunity that we have available, 355 units, brand new student housing that we're building in Buffalo. So this is a 23% projected return opportunity. We've already invested, 50 investors have invested $6.2 million. That was phase 1. It closed a while back. Phase 2 will open this summer. So for those that are interested in investing, we're taking, again, we're not ready for money yet, but we're talking to people about getting some reservations into that opportunity. Also, for those of you that like my data-driven approach, I teach a couple times in a year an apartment boot camp. It's called Apartment Magic. Today we're going to talk about this, a little bit about this, but then when we start talking about neighborhoods, about the secret sauces, how to work with property managers, how to evaluate properties, how to find properties, how to find brokers, it's very prescriptive, it's very step-by-step, and it's very demo-driven. I really hate PowerPoint. I like demos. So there's 65 demos of exactly the process, the step-by-step, real phone calls with brokers, real phone calls with property managers. And that bootcamp is at multifamilyu.com. Check it out. It's not one of those $40,000 boot camps. It's a few $100. Check it out. You'll really enjoy it. It starts, I believe, next Monday evening. It's an evening event. Let me click past this. All right, time for the shootout. So this took an enormous amount of time to put together because this year I wanted to give you, I'm going to again skip past this, so just a Nostradamus joke, right? Predictions are tough, so don't beat me up too much if this doesn't work out. I think it will. So here's my buckets. Orange is, these are the cities that are projected to have strong or very strong rent growth. Now, they may not be cash flowing cities. What I'm saying is, if you get 2 years of cash flow at this level, they become cash flowing cities. Right? You buy something there, you get 10% and 10% for 2 years, you're cash flowing just fine. Right? So you're okay. So those are the cities that show up here. This is the hottest category. So when Zillow says these are the hottest cities, they don't mean price appreciation. They don't mean rent appreciation. They mean that those cities, homes fly off the shelves. You get lots of offers. You get cash offers. You get 200 people showing up for an open house, right? Those cities are ideal for fix and flip. And as you can imagine, there's going to be Bay Area components in there because some of the biggest cities, some of the most powerful cities tend to show up in the blue section, but they're not necessarily stars when it comes to price appreciation or rent appreciation, right? So this is a kind of different style of city here. And then, of course, cities that are where the prices of single families are going to go up. And again, you notice I have a lot of different providers. So Yardi, and Apartment List, and Zillow, Trulia, Realtor.com. Why? Because I want to see patterns. If it shows up in a list, I don't care if it's number one. I want to see it in other lists. I want to see it across the list. And even more than that, I don't just want to see it here, here, and here. I want to see a city that shows up here, and then it shows up here, and then it shows up here. Because you can't lose if you go to a city like that. Right? That's my goal. So it took a long time to put this all together. Now, another thing I want to tell you is I am not going to talk about all the cities. Because if it only shows up once, I'm really not that interested in it. Right? Because I'm looking for patterns. So you'll see me skip cities as I go through. So, number 10, I see 2 cities in California. I really loved how much California there was here. Inland Empire and Fresno. Keep an eye on Vegas. It's going to come up again. And then Twin Cities, St. Paul and Minneapolis. Santa Ana, another California city for cash flow. Another California city for cash flow. So California is really interesting right now in that there's a lot of cash flow cities coming up. Los Angeles, again. Tampa in Florida. Dallas, and then what is this? Where's Arlington? No. Texas, right? This is Dallas Metro, right? So Dallas comes up twice. Salt Lake City, keep an eye on Salt Lake City. You'll see a lot of it. And then once again, Tampa comes up. This one's very interesting. A few months ago, the Canadians started putting a huge tax on, investors, foreign investors buying real estate in Vancouver, right? Well, half of Vancouver is on our side of the pond. That part became ultra hot immediately because those people didn't want that 15% tax, so they started buying on the American side. And so I immediately started noticing this going up on the list. This one's very interesting. What metro is Deltona in? Orlando. So in your mind, scratch this off, because this is Orlando, and see how many times it comes up. Phoenix, I'm very sad about this. This is a city that I talk about a lot as a great city, but the numbers don't support me. It is the only time that Phoenix will show up here. I'm not sure if this is a blip. I'm not sure if this is the end of the enormous growth that Phoenix has seen in the last 3 years. So I'm just befuddled that it's the only time it shows up. You're going to see Salt Lake City a lot. You're going to see Colorado Springs a lot. And every time you see Colorado Springs, almost immediately, you're going to see Denver. Because this is a symbiotic relationship. Colorado Springs is 70 miles south of Denver, people actually live in Colorado Springs and commute to Denver. So as Denver's gotten hot and more expensive, you see Colorado Springs come up almost at the same level in the rankings. Los Angeles, yet again, for cash flow. And then at number 3, no surprise there, Las Vegas. Nevada is currently ranked as the second fastest growing state in the union. What's the fastest growing state in the U.S.? Ah, awesome. Yes, very up to date. Yes, that's right. At this point, it's Idaho, but it used to be Utah. So for 2 years in a row, Utah was number 1. And then a few months ago, Idaho took over as the fastest growing state. But in both of those realms, Nevada was number 2. So it was number 2 before and still is at this point second fastest growing in the U.S. But again, Orlando. And I want you to keep an eye on Orlando because it's going to come up again right there. Orlando. I see a pattern developing here. You see a lot of Orlando coming up. Unfortunately, the only time that Reno came up. You know, there's at least a couple Reno lovers in this room. This is a tremendous city. The only thing I can say in its defense is it shows up a lot on the multifamily side. So this is not that forum, but if you look at the multifamily forum, or Reno is ranked very, very highly. And then you see Sacramento, right? And watch again what happens when we go to number 1. The city that is unquestionably the best for rent growth in the U.S., anywhere in the U.S., Sacramento, Sacramento, Sacramento. Across the board, it crushed it. You are not going to see anything like this. What is amazing is Sacramento's projected rent growth for 2018 is double digits, which is about half. It's double of Fresno. So this is about 5.5%. This is 11%. When you go into a city that doesn't cash flow and you get 11% the first year, your non-cash flowing, property has turned into a cash flowing property in 1 year. All of these rankings are for the metro area. I personally don't like the city of Sacramento. I like the metro. So I'm not very fond and would not buy inside city limits. So I like everything around it. So the short answer is the Bay Area. So there appears to be no job drivers. So the city with the strongest job drivers for 2018 is Orlando. So it's 3.6% growth. Sacramento's okay. It's in a good place. 2% job growth is considered to be above trend. But it's nothing spectacular. It's just inward migration. 85% of the inward migration is from the San Francisco Bay Area. So just massive, people moving there. The other piece of it is Sacramento got hit very hard during the recession, right? They didn't build. So construction only started in Sacramento in late 2016. But the population has been growing throughout the recession. They didn't see much of a population dip. So now it's going to take them 3 or 4 years to catch up to all that growth, and that's why they're seeing huge rent growth. By the way, just so you know, the winner for last year was Sacramento, Sacramento, Sacramento. Very consistent. It worked out, yes. So throughout the year, Sacramento maintained the growth, and I think ended up slightly higher than projected. Yes, I will do that. Yeah. Oh, yeah. We got an online audience, right? Okay. Thank you. All right. So let's go to hottest fix and flip. And obviously, this is the great hope for California. So coming in at 10 is Dallas, but this is really interesting. Stockton? What the heck? I don't think of Stockton as a fix and flip market. I don't think of Stockton as a market, right? But people disagree with me. At this point, Stockton seems to be having a recovery, and if I saw it once, I would just ignore it. I wouldn't talk about it. It's going to come again, and you're going to see it in a place that's unexpected. So Portland and Denver are traditional fix and flip markets. They're awesome markets. They will continue to be awesome markets, and so will Nashville. But here's a brand new fix and flip market, right? Usually don't think about Sacramento as a fix and flip market, but if you're going to have rent growth like that year after year after year, it's going to become one. So now people are buying 50, 60, 80-year-old properties in Sacramento and fixing them up and selling them for $50,000 profits. In the Bay Area, we're struggling to get $10,000 for our flips. Denver, another tremendous fix and flip market. Santa Rosa, I think this is a one-year effect. I think that's just what happened with the fire. Austin, San Diego are terrific markets for fix and flip. They will continue to be. San Francisco is known as a tremendous fix and flip market. Midland, Texas is a shale market, so some years it's the weakest market in the U.S., and other years it's the strongest market in the U.S., so a very dangerous market. Charlotte is a tremendous city. You will see North Carolina again and again come up. Something really awesome is happening in North Carolina. And then Colorado Springs came up, Denver came up. This is kind of a symbiotic relationship between these two cities. Seattle is a phenomenal fix and flip market. Now, outside of these sources, I've looked at some others, and Seattle shows up number one on a number of other surveys. It also is very, very highly ranked for multifamily. I think it's either 1 or 2 in the U.S. for multifamily. I am looking in Seattle. I'm making offers in Seattle. I think it's a terrific market for 2018. I'm not so sure about a 5-year term, but at this point, it's befuddled me because I thought it was coming to the end of its run, but now there's a lot of new job announcements coming in, right? We've got Google, we've got Apple, there's a whole bunch of slew of new announcements, so I think the city gets another 3 years to run. Yes? So I think that Sacramento is more challenging for multifamily. I think Orlando is much better. Sacramento is very, very challenging from a cap rate perspective and also inventory. Orlando is a bigger metro, right? So there's twice as many people in Orlando as there are in Sacramento. So there's more opportunity. There's more stuff out there. It is. So actually, John, offline, I'll give you the multifamily rankings because I know you're in that business. Okay. Multifamily is more challenging in Sacramento simply because of lack of inventory. So at this point, Sacramento is such a hot market, and there's so many Californian investors that are willing to take extraordinarily low cap rates that it's just not a very attractive market. You're just not going to be able to make money. All right, so coming in at number 2 on hottest fix and flip are 2 outstanding markets, Raleigh, North Carolina, and San Jose. Consistently, it appears that the market that's going to be hottest throughout the year is San Jose, which is also why it comes in at number 1. So the best flip market of the year, unquestionably, there's 6 other rankings I've looked at, is San Jose. 9 out of the top 10 flip neighborhoods in 2018 are in San Jose. Anybody that wants the list of those top 10 neighborhoods, send me an email and I'll send you the names of the neighborhoods. So San Francisco, again, no doubt. Clearly, the Bay Area cities retain their pole positions as the best flip markets in the U.S. Yep. So from a fundamentals perspective, no, because it's a small number of units. From a mind share perspective, heck yeah. Everyone thinks that Google is making 1 million apartments. They're not. But look at how many headlines they get. So I think perception is reality. So the real answer is yes. But for a city of 1 million people, they're not building a lot. All right, appreciations. This is interesting, right? So you're all Californians who are thinking, we're going to ace this, right? We did really well on this side. We're going to do awesome here. Who can beat us in appreciation? We'll see. All right, number 10, Sacramento, again coming in for appreciation. What's interesting is it was higher last year. So here's what happens. Cities go through that appreciation phase, and then what happens is everybody who's bought or can afford to buy has already bought. So what happens is rents start to go up. So cities actually migrate from the green side over to this side, and the fact that it's really up here at the top, but down here at number 10 means that its appreciation phase is ending. But it's going to be a great rental market for a while, and it'll also be a good flip market because mature markets tend to show up in this section. So here's one of my favorite markets, right? So my company made a really good decision. We started selling Dallas, and we started buying Fort Worth. And you're going to see Fort Worth show up multiple times. Fort Worth is a sister city of Dallas, same metro, and it's doing really, really well. At this point, the rent growth there and the price appreciation is significantly higher than Dallas. You're going to see Colorado Springs one more time. And also, my favorite Midwest city is Columbus, Ohio. I think that there's a lot of cities in the Midwest that are recovering, that are doing well, that obviously Midwest cities are more risky, but at the same time, this is a good time. A number of them are going upwards. But this city is very, very unique in its population growth. There's no city in the Midwest that has population growth as rapid as Columbus. Also, there's no city that is gaining technology companies as fast as Columbus. So
if you like the Midwest, this is a terrific city to invest in. It's more expensive, unfortunately, than all of the other Midwest cities, but it's worth it because I think that this is a long-term dark horse. Atlanta shows up, Charlotte, Austin, 3 terrific cities for appreciation. Nashville again, Salt Lake City. And there's going to be a theme here that we're going to talk about that's related to Salt Lake City in Utah. Fort Worth shows up yet again. Here again, Salt Lake City. Ogden is Salt Lake City Metro. It's about 40 miles north of Salt Lake City. And here's an interesting one. So, you guys know what the term path of progress means? Right? So, jobs and progress flow like a river through a metro. And it twists and it turns, and sometimes it stems and sometimes goes backward, and then starts to flow again. In the US these days, the path of progress flows along freeways, right? So it doesn't go very far from a freeway. Usually doesn't go more than 2 or 3 miles from a freeway. So here's something that I'm going to speculate on, and you guys should do more research on if you're interested in investing in Florida. I believe that the path of progress starts in the city of Deltona, which is 15 miles north of Orlando. Then it flows through Freeway 4, through Orlando, and travels due east where it hits the city of Lakeland. And then it travels again for about 40 miles and hits Tampa. That stretch of freeway is only 103 miles, but 7 times in this list you're going to see cities on that stretch. That is a golden path. Practically anything that you buy there, you're in a very, very good place. Deltona and Tampa. So Raleigh-Durham shows up again, and then here's Stockton. Come on, there's 1,000 cities in the US, and Stockton shows up at number 4. It's not my favorite city. I love to bash Stockton, but obviously there's something good going on there for the city to show up both on the fix and flip side and on the growth side and beat a bunch of great cities, right? So Phoenix didn't show up in this list. Stockton did. So it's something to keep an eye on. I'm not so sure about its long-term prospects, guys. But at this point, I think that it's going to have an appreciation benefit. It's going to have a rent growth benefit as well. So keep an eye on it. And then at number 3, Jacksonville. This was a very hot city. In previous years, this would show up multiple times. But it seems like everything's slowing down in Florida, whether it's the Miami portion or the Jacksonville portion. It's just that golden freeway, that 115 miles that's going to show up again and again. And you see it again. Deltona, right? Yet again. Not an independent metro. It's a small city in Orlando metro. And then Raleigh again. Raleigh-Durham. There's some consistency to this, right? These vendors are all agreeing with each other. And then at number 2, my favorite city in the US, I love Provo, Utah. I've been talking about Provo, Utah to anybody that will listen for years. I tried to buy there, I failed, and then I built. I really hate building. I just finished building a gorgeous 102 unit. Chris and I are going to go check out that unit, that building, because it's complete, so we're going there for the inauguration and the opening of the building next Thursday and Friday. So he's going to spend 2 days with me while I meet with brokers trying to find more properties, trying to find land, trying to find everything. So Provo is ranked number 2 in this list, but in the fastest growing cities in America ranking, which is not in this list because it doesn't really agree with the others, Provo has been consistently number 1 in the US. Why? Because it has a unique trifecta. I don't know of any other place in the US that has this. A world-class university, Brigham Young, so terrific tech students. A lot of technology companies moving there. Adobe just moved there. They've had $2 billion unicorns in the last year. Google has wired the whole thing for free. Here are the three that you can. And then the third part, which a lot of people don't appreciate, and that is that skiing, world-class skiing, is 20 minutes away. It attracts students from all over the U.S. So they have a very young, very hip student population that's very, very tech-savvy. And the fourth part, which applies to all of Utah, not just Provo, is Mormons make lots of babies. You always want to invest in a place where people make lots of babies, because population growth is the biggest single factor of rent growth, right? And price appreciation.
So I love Provo, and you're going to see more of it come up. If you can get your hands on anything in Provo, buy. Buy now. It's in for a 10-year run. At the end of it, that run, it becomes Austin. So that's how far Provo can go. It's tiny compared to Austin, but I believe it's the next Austin. Dallas shows up there, very, very consistent. We're going to talk more about this. And at number 1 for price growth in the U.S., Orlando and Las Vegas. Right? I don't know anything about Grand Rapids, Michigan. I've never seen it before, and I probably will never see it again. But these cities come up very consistently, Orlando and Las Vegas, for number 1 price appreciation. And unfortunately, we didn't see much California this year. Lots of California, not much California. In fact, if you summarize California, you see it's very heavy on this side. The only city in this entire list of 80 cities that was consistent all the way across is Sacramento. Right? I think you cannot lose with a city that shows up in all 3 of these 8 different providers. So, from a fix and flip perspective, obviously we keep our pole position, but there isn't a lot of price appreciation. If you are making bets on price appreciation, for God's sake, look at this side. There isn't much. I think we've ended that phase. Sure. Do these folks sign in? Do they sign into an iPad or something like that? They did, right? Oh, you're going to get the whole presentation. I send out the deck. Don't worry about it. All right, so Texas came in second, right? California winning this year. Texas came in with 11 listings. But really, if you think about it, it's sporadic. There's only one metro that matters. Dallas, Dallas Metro, Dallas, Dallas Metro, Dallas Metro, Dallas. 6 times. 3 different cities. It's just one metro. It's incredibly powerful. I think it's set up for a good run because you can see it on all sides, right? It's everywhere. And that's the power of Dallas. It's a tremendous metro. Comes in only second to Orlando. Well, comes in second to, or third to Orlando and Sacramento in my mind. And with that, we go to Florida. Once again, you see Florida, not a good performance this year. There's definitely slowdown, but this area is phenomenal. Yes. So we're talking about Dallas overbuilding, right? The short answer is no. I do not believe that at all. I think Dallas is becoming a core market. So what happens is, in a core market, cap rates are lower, prices are higher. That does not in any way mean that they're overbuilt. Cities in the U.S. that are overbuilt are Washington, D.C., Houston, right? Nashville to some extent, maybe not as much. But I don't see overbuilding in Dallas because I think that the city is absorbing it. But there's a slowdown. So slowdown and overbuilding are not even remotely close to each other. All right, so we talked about Colorado, very consistent, just 170-mile, set from Denver to Colorado Springs. Unfortunately, quite expensive. And then here you see Utah coming in at number 5 in our list. North of Utah, Salt Lake City, south of Utah. Terrific market. If you can get in, Utah is fundamentally the strongest market in the U.S. for a variety of reasons. It's inexpensive, it's tech savvy, it still hasn't recovered. Home prices are significantly below where they were in 2006. If you can find something, grab it. So, honorable mentions, 2 states that didn't make it to this list. North Carolina, 5 entries, 3 for Raleigh, 2 for Charlotte. And then Nevada, 3 entries for Las Vegas, including a top position. So don't ignore Nevada. And then once for Reno. I was shattered to see Reno only once in this list because I think it is a terrific market. But I think that there's concerns about cash flow. At this point, everybody and their mother wants to buy in Reno, which means it's very difficult to find anything that will cash flow. Okay, this is where I stick my very long neck out for you guys to chop off. So when I come back in a year, you tell me if I did okay. So my California pick is actually a tiny city.
I'm not even going to ask for guesses because nobody's going to figure this one out. But at the moment I explain why, you're going to go, okay, that's why. So I think the city that is going to outperform, it's going to do really, really well on both the appreciation and rent side, is Yuba City. It is 50 miles north of Sacramento. And because it's an upscale city, right? There's actually people that live in Yuba City that have nicer, newer homes than Sacramento. Sacramento is an old city. This city is doing really, really well. Plus, they have a lot of interesting things going on. So if you look at the city, it's got some cash flow. The number of rentals listed on Trulia has quadrupled in 2 years for a small city. But it's still fairly affordable. Median rents are $1,500. You can get starter homes for under $200K. It's already ranked number 7 in the US for best performing small cities, right? That's a tough ranking because small cities, we're talking about 3,000 of them. To be ranked number 7, you're not in the top 1%, you're in the 1% of 1%. Right? That's very, very hard, and this is why. Beale Air Force growth is the direct beneficiary of what the Trump administration is doing with defense. Healthcare is adding 7,000 jobs. In a city that's only 150,000 people, that's a lot of jobs. But even more, they're building a $170 million casino called Calusa. Right? So the economy is going through this massive spurt, and you can still take advantage of this. Right? So for those of you that want to stay in California, check out Yuba City. Honorable mention, right? Cities that didn't make it on here, Visalia and Riverside. I have no idea what's going on in Visalia, but something is, because this is the 3rd year it has shown up in my lists, and it has done really well the past 2 years. But still it shows up here with pretty high numbers. So I don't know, maybe some ag companies getting into it. It's an agricultural area. It's 40 miles south of Fresno. Something's going on there, right? So keep an eye on it. Okay, my prediction, and this is a city that I'm going to be visiting a lot in 2018. This is where I'm looking to invest. It didn't show up in our 2018 lists, but I'm predicting it's going to show up multiple times when I'm back here a year from now. This is a city that is filled with potatoes, and it is Boise, Idaho. I'm sorry, this is actually Wyoming, so I've got to move that over. I've got to fix that. Whoops. There we go. Just move it to the left, 4 inches. Everyone makes a mistake, damn it. So Boise has some interesting things happening. When I look at the multifamily rankings from providers like Marcus & Millichap or even JLL, there's a lot of people. I'm talking to people here in this group, right there. Yes, somebody that is thinking right now about investing in Boise, right? I'm saying, wow, I'm looking at the same damn data. There's validation. These guys are JLL. They know what the shit they're talking about. So I'm really happy to hear that. And I'm on my way there because of this. There's a lot going on. Number 1, lowest cost metro. Cost matters a lot. And I'm not talking about technology company. Every company cares about cost. And this is the only low-cost metro left in the Pacific, right? That also has been voted multiple times best city to live. Multiple times. There's at least 4 different listings that it has won in the last 2 or 3 years. Either voted number 1 or number 2. And then this is something I look at, right? I constantly look at rankings for college grads because tech companies follow college grads. Right? They want to do that. It's voted number 2. There's a couple other rankings that it's voted in the top 5. And then here's another one that's becoming more important. Number 2 best state for property tax rate. This is a big deal, right? Because we're all suffering from these oppressive property tax regimes. And you have something that's very close. It's an hour and 55 minutes away. It's still a small metro. All of Boise Metro is 700,000 people. So it's very small, but it's fast growing. And people in Idaho like to buy real estate there. So it's kind of hard to get deals, but there is a lot of land available. So when I go there in 4 weeks, I'm talking with 6 or 7 land brokers. Because I think right now, it's a good land bet. The problem with Provo is I can't buy any kind of land of any size, right? But Provo is 2 or 3 years ahead of where Boise is. So it's a great time for those of you that are interested in land. For those of you that are interested in investing in Boise, come talk with me. I don't mind chatting with you about what I'm up to there, and I'll give you my connections. Have at it. So that's what's happening with Boise. Here's 2 other cities, and interesting enough, they're also in the West. I don't know what it is. This year, the Pacific Northwest is doing really, really well. Salem, Oregon, and Tacoma, Washington. Tacoma has that symbiotic relationship with Seattle. In fact, the airport is called SeaTac, right? So the area between Seattle and Tacoma is some of the highest rated, fastest growing land in the US. So my next project, beyond the one that I showed you today, that will be announced is a senior housing project that is in that area. So it's a new construction senior housing product, 150 assisted living units and 20 memory care units. So I love the Seattle metro. It's very expensive. I couldn't buy there, so I have to build. But that area is phenomenal. Seattle, I think, is an amazing city. But Tacoma is better for cash flow, simply because at this point you can live in Tacoma or northern Tacoma and you can commute to the southern half of Seattle. So that city is going to do really, really well. All right? And so those are our predictions. That's our presentation. Questions? I know it takes a minute and then they start coming. Yes? It's about number of offers, and then how much above list does it go, and how quickly does it go. So hot means speed, right? Acceleration. They're not necessarily saying it's a fast appreciating city, because actually San Francisco is not even in the top 50% in the US in terms of appreciation at this point, but it's very hot. Stuff gets picked up very, very, very quickly, right? A lot of people are bidding. They're not necessarily bidding way higher than other cities. Yeah. No, not at all. So I look at the total amount of inventory that's coming to San Francisco. It's barely sustainable in terms of what the city needs. So I don't see overbuilding. At this point, there doesn't appear to be any evidence of overbuilding at all. I think what I am afraid of is, and I want to talk with you guys about this, because I mean, obviously you're investing here. I don't invest in California, but you do. How many of you know that a few weeks ago, a bill went to committee in Sacramento? It was a statewide rent control tax bill. How many of you know that there was a bill? How many votes did it fail by? Do you know? It failed by one vote. Statewide, socialist level rent control, and it failed in committee by one bill. That scared one single vote. That scares the shit out of me, right? Because the moment that goes into effect, any municipality that is leaning in that direction now has a free hand. San Mateo just went for rent control, right? You guys know about this? There's brokers screaming on the streets in San Mateo because they're going for rent control. And that scares me. I'm not worried about overbuilding. I don't see much evidence of that. But I think that the state is getting overly socialist at this point in time. There is no evidence that rent control works. San Francisco has rent controls. You also have the highest rents in the US, right? Oakland. It doesn't work. There is no evidence, but the city right now, people are screaming. So, they're making wrong decisions. But when something like that fails by one vote, it tells me it's not just some crackpot that put a bill up and it got shot down. A single vote. No, so the question is, what are the implications if that bill would have passed? The short answer is, it frees up the hands of the local communities, and it puts mandates in that they have to meet by a certain time. There's a significant amount of flexibility in it, but every city would have to implement some form of rent control. So you're looking at hundreds of cities in California that would have to comply with that over the next, I think, 4, 5, 6 years. But I don't know what the heck that would do to our real estate. I don't know if it's going to go up or go down, because no one has ever implemented rent control over an area of 40 million people. It's just unheard of. The question is, the bigger issue is vacancy control? So I mean, the point is this: yes, they were trying to fix something that should be looked at. The problem is when you start getting the government involved, you're going to have somebody that's ultra liberal go the whole hog. The bill will completely mutate as it goes through committee and goes up to vote, and the end result is not going to be something that any real estate investor is going to be happy with. So it's something to keep an eye on. I really don't know what its chances are, but I don't like the fact that it lost by 1 vote. I would have liked it to have lost by 20. No, I at this point, the question is about Seattle getting rent control. I think there's a few people interested. I don't think that they're anywhere close to a majority at this point, so I'm not worried about it. Also, Seattle, the way that it's broken up, it would be municipality level, not county level. So if it gets it, it might be like one tiny little piece of Seattle. So I'm not worried about it, no. So the question is about tiny homes, right? I think fundamentally they're a brilliant idea. But I've talked to a lot of people developing them, and what they say is when they start out, everyone seems to say all the right stuff. But once they get into the zoning process, they find that it's extremely difficult. Give me one example, anywhere in California, of a scaled tiny home community. I know there are none. So, and tiny homes are not new. People have been talking about them now for 5 years. So, I don't know what it is, but in the zoning process, they always get stuck. So to me, it is a fringe phenomenon that just doesn't come into the mainstream unless there's some kind of a major law change. It's a fringe. It doesn't fix anything. That's right. Americans are getting bigger. So we don't fix in tiny homes. We need giant tiny homes. All right, here's a question. Yes. Mm-hmm. 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 Sure. Right. 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 Mm-hmm. Sure. Well, I think so short the question is about, the viability of Airbnb type property. So I take a slightly contrarian approach. A lot of people are afraid of the law there, but I think that it is going to become more accepted over time. I think that, yes, it's going to get taxed. I think, yes, it's going to, not be allowed in certain locations, but I think that it is not a fringe industry. I think that we are beyond the tipping point. And I think that it grows to be a significantly larger portion of the hotel market in 10 years than it is today. That's my feel. I think that happens across the board in the US. Yes, there will be individual cities that will fight with Airbnb and VRBO. And, obviously you have to keep an eye on the local news. But I think as a overall phenomenon, I think it keeps growing, and it keeps growing very fast. All right, so I think that was the last question. We got to stop at this point. I'm going to hand this over to Ryder. Yes, one more question for Ryder. Special question, host question. Mm-hmm. So interest rates would now be a good time to refinance. So short answer is yes or no. Do your math. Interest rates will go up, but the Federal Reserve, when they raise interest rates by 1 point, that doesn't make mortgage rates go up by 1 point. Mortgage rates and interest rates are separate. The Federal Reserve doesn't control mortgage rates. The last time, in last December, they raised mortgage rates, interest rates went down. So to me, it seems like interest rates are likely, or mortgage rates are likely to go up by about
3/4 of a point to 1 point and then stall for a while. So if you're looking at it 2 years out and you're okay with a 1 point increase, I wouldn't refinance because there's costs of refinancing. What I don't see happening is they go up 1%, then they go up another 1%, then they go up another 1%. Because honestly, at this point, our economy cannot afford those rates to be higher than 5. So the entire economy, not just real estate, stalls right around 5.25. And so at that point, growth slows, which means that the Fed can't raise rates anymore, and they stop, right? So from now to then, 1 point increase, not 1 point a year. So make your decision based on that. Okay. All right. Back to Chris.
Cool. Okay, let's hear it from Neal one more time. Okay. So